Hey everyone, J3 here and welcome to video number 2 of Take the Leap, Invest Within the Week online seminar series. In this video, I'm very excited to share with you the basics of the stock market and how it works. But before that, I'd like to first say thank you for your responses and comments in the first video. I truly appreciate everything that you've been saying, and it's energizing me to give more and more in this seminar series. So today, we'll be talking about three main things. First, the basics of the stock market, which is part A. Then, we'll talk about how to minimize risks in investing, which is part B. And then the methods on how you can invest in the stock market, which is part C. Now, before we begin, I would first like to destroy the belief that the stock market is complicated. You see, the stock market is actually very simple. Some people just want it to become complicated. As we go through this seminar series, keep that in mind because I'll be presenting the stock market in the simplest but also the most comprehensive way possible. So at the end of it, you might have the feeling that it's bitin or lacking, but actually it's not. It was just trimmed down to the most essential parts. Now, think of the stock market like a remote control. Here's what I mean. This is our remote control at home. And as you can see, there are a lot of buttons. And my mom has a lot of trouble with it. And sometimes she even calls me just to change the channel. But here's the thing. Once you learn how to use it, you'll know that there are only 5 buttons which you need to know in order to use it. The total number of buttons in this remote control is 49. But you only need 5 buttons to use it. Channel up, channel down, volume up, volume down, and the power button. That's it. The rest of the buttons, they are rarely used. Now, I honestly haven't pressed some of the buttons since we got the TV. Anyway, that's how the stock market is also. There will be a lot of options, and there will be a lot of buttons that you can press. But you only need to learn a few of them, and that's what we'll talk about in this video. So, what is the stock market? The stock market is only 4 things. It's a place where shares of stock of publicly listed companies are bought and sold. We'll go through these points one by one. First, it's a place. The stock market is actually located with the Philippine Stock Exchange or the PSE. The PSE has 2 offices, one in Ortigas and one in Makati. But don't worry because you don't have to go there in order to transact with them. Now, the next item are shares of stock. Stocks represent ownership of a company. Now, here's something that will help you understand the concept of shares. The business types and the number of shares it has. In a sole proprietorship, meaning there's only one owner, there's only one shareholder, which is the founder. In a partnership, there are 2 or more owners, so there are also 2 or more shareholders. With corporations, there are very many shareholders that can reach up to hundreds of thousands. These shares are what's bought and sold in the stock market. But take note, not all corporations are in the stock market, only those which are publicly listed. A publicly listed company is a company that is traded in the Philippine Stock Exchange. Now, as of 2012, there are already 340 plus companies listed in the stock exchange. This list grows every year. Now, here's why companies get listed with a PSE. When a company wants to expand its operations, it's going to need a lot of money. When it needs money, it has 2 options. Number 1, borrow money, or number 2, look for investors. By borrowing money, the company has to incur expenses to pay off the interest from the debt. Now, if they look for investors, they will just have to share the future profits in their business. Now, if they would want to look for investors publicly, they would have to go through the PSE. They apply to the PSE so that they would be able to sell their shares to public individuals like you and me. So it's the PSE that screens these companies. They make sure that the companies are legit, have a track record of business, and won't just suddenly disappear. In this manner, the PSE protects us as investors. Now, I said a while ago that we don't need to go to the PSE in order to transact with them. The reason is that the PSE has authorized the trading participants, or more popularly known as brokers, to manage the buying and selling the shares of stock. And it is only through these brokers that us individuals can invest in the stock market. So with this, you just have to remember the four groups of people that make the stock market work. The company that needs to expand, the PSE that screens the companies, the broker that provides us the way to buy and sell shares of stock, and of course, us, the investing public. With that, let's go on to the more interesting part on how money is made. There are two ways on how you can make money in the stock market. And in both of them, you'll have to remember that what you are investing in are businesses. So, you will make money in the same way business owners make money. The first way is through dividends. This is your share of the company's profit. When the company makes money, since you're also an owner, a shareholder, you also make money. So some people ask me, why on earth would a company want to distribute money to its shareholders? Why don't they just keep it all to themselves? Well, here's the reason. It's because they are also shareholders of the company. The owners, the majority owners of the company, they are also shareholders. So it is through the dividends that the owners are able to pay themselves legally. In this picture, what you're seeing is a dividend declaration from the company First Philippine Holdings, or FPH. Now, this is a screenshot of the email my broker sent me of the dividend, which was declared last December 2012. So as you can see here, the shareholders were given 1 peso per share, and since I owned 2,120 shares, I got a dividend of 2,120 pesos. After the 10% withholding tax, I got 1,908 without doing anything. Now, this amount may be small or big to you depending on where you are financially, but what I'd like to highlight here is that this is pure passive income. It didn't matter what I was doing days, weeks, and months before that. It didn't matter if I worked, slept, went on vacation. I would have still received this money just because I owned shares of FPH. I got a share of their profit. Now, the second way you make money in the stock market is through capital gains. When the company you buy grows 5, 10, 15 years down the road, then the value of each share would also go higher. This is where the notion of the buy low, sell high comes from. So, as an example, let's consider the home of our dancing bubuyog, Jollibee. Here you can see the stock price of Jollibee over the years. In 2003, the stock price was a little under 20 pesos. In 2005 and 2007, the stock price already grew to the 30 to 40 peso level. Today, the price of Jollibee is 100 plus per share. Now, this has a lot to do with Jollibee's continuous expansion of its business. At the start, Jollibee was just an ice cream place. Then it expanded to Yum Burgers and Chicken Joys. Then it started purchasing other food franchises like Greenwich, Chowking, Red Ribbon, and Bang Inasal. So, as the business grows, the value of each share of Jollibee also grows with it. This is capital gains. So, as a quick recap on how you make money in the stock market, the first way is through dividends, which is your share of the profits. The second way is through capital gains, which is the increase of the value of each share. If you're having trouble understanding this, I guess the best way to put it is like this. With capital gains, imagine buying a small tree, then selling it when it becomes bigger. Then, as the tree grows, you get its fruits. Those are the dividends. So how much money can you make in the stock market? Well, it depends. The first thing that you have to remember is that it's always a percentage of the money you put in. So everything in the stock market will be talking in percent, not in absolute values. The second thing is that it's going to be relative to what's happening in the stock market. Here's what I mean. What I'm showing you now is the chart of the PSE index or PSEI over the past 25 years. The PSE index is a basket of different companies from different industries in the Philippine stock market. In a way, it represents the whole direction of the Philippine stock market. So as you can see here, in 1987, the price of the PSEI was less than 1,000 pesos. In 1997, the PSEI shot up to the 3,000 level. But in 2003, it went all the way back down to less than the 1,000 peso level. In 2007, the market recovered, went down again in 2009, but as of 2012, entering 2013, the market is soaring. Now, what I mean by relative is that during the periods when the PSEI is going up, like from 2003 to 2007, you should be making money. Actually, even if you don't know what you're doing, you could still make money. In that period, if you doubled your money, that was very reasonable and, well, easy to do. It's because the whole market is going up anyway. However, when the market is going down, like in 2007 to 2009, if you made money in that period, then you're a great investor. When everything is going down and that you manage to make your money grow, well, that's a sign that you're a very, very good investor. So that's how the stock market goes in a very general and average sense. It goes up and it goes down and it goes up and it goes down. But the comforting fact here is that it goes up more than it goes down. In this period, the average growth of the stock market is at 13% per year. Now, I'd like to help you appreciate this number, this 13% per year for a while. Because 13% is so much higher than what you can get from bank deposits and savings accounts. It's a lot higher from what you can get from retail treasury bonds, which are just around 5% per year. And it's much higher than what you can get with pre-need plans. Relating this to our first video, the 13% is so much higher than our inflation rate, which has been averaging only at 5.5%. So the stock market also beats inflation. So, what is 13% per year? It's doubling your money in 6 years. It's tripling your money in 9 years. It's multiplying your money times 5 in 14 years. And it's times 10 in 19 years. And it's 20 times in 25 years. So, that's what it means to grow your money at 13% per year. With these numbers, isn't it easier to accumulate wealth for your retirement and achieving financial freedom? That's the power of starting to use the stock market in your life right now. Now, just a little disclaimer, this is not guaranteed. The stock market may return lower or higher than the 13% in the future. And I honestly don't know how much money you will be able to make in the stock market. It can also be higher or lower. But hey, on average and in the long run, you can make your money grow in the stock market. Now, I'm going to go a little bit off topic for now to address another important point with investing, and that concept is risk. In the graph of the PSEI I showed you, you might have noticed that it's going up and going down, going up and down, up and down. So it's quite natural to be scared in considering the risk of it going down. So what I'd like to immediately address is this one very important question. Is the stock market risky? Well, the best answer to that question, and all questions about risk in investing, is from this book, Who Took My Money by Robert Kiyosaki. And he said, it's not the investment that is risky, it's the investor. This is Robert Kiyosaki's less popular books, but personally I think it's his best one. It's a great book to read after reading Rich Dad Poor Dad. Anyway, what he is saying is this: stop blaming the investment because risk belongs to the investor. Now, investing is just like driving. There are risky drivers out there who swerve, don't follow the stoplights, cut off other drivers, and these are your risky drivers. But there are also safe drivers out there. They are the ones that follow the speed limit, signals to the left and to the right when they're turning. So it's the same thing with investing. You can be a risky investor or a safe investor. It depends on whether you would want to follow the rules or not. And of course, here you'll learn how to be a safe and intelligent investor. Now, here's an example of a risky investor. Here's a guy on Facebook asking in a forum what he should do with his money. He asks, if I have 50,000 pesos right now and will invest the money in 6 months, what company should I invest with? Now, this is something very, very risky because he's asking a bunch of strangers on what he should do with this money. Imagine going out in the streets and asking random people what to invest in. This guy has no idea who he's asking, what their motivations are, what their investing strategies are, and yet he's asking for their opinions on what to buy. This guy is putting himself in a lot of risk. Now, take a look at one of the replies. It says, get an insurance for yourself and health insurance for you and your family, then pay for Philippine debt. Lols. Damn! There are 36 other comments just like that. Some are better, some are worse, and some are really But honestly, I don't think he'll be able to tell the difference between the good and bad advice. You see, the primary source of risk is ignorance. There are good and bad investments. The risk is when you do not know how to tell the difference. With that, I'd like you to take a moment to absorb that lesson. Because after learning this, I felt great. I felt empowered. It felt great to know that success in the stock market, or any investment for that matter, didn't depend on chance. Rather, it depended on disciplined study. Here's another quote from a book that will really change your perspective on investing. It's from the book The Intelligent Investor, written by Benjamin Graham. Now, for those of you who don't know Benjamin Graham, he is Warren Buffett's mentor in investing. So this book right here is the source for investing intelligence. And the quote that I'm going to read to you will truly change your mindset when it comes to risk and investing. And it says, it has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rates of return sought should be dependent on the amount of intelligent effort the investor is willing and able to bear on his task. The minimum return goes to the passive investor who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises a maximum intelligence and skill. Now, I know that that was a pretty long quote. Here's the short version. High risk, high return is wrong. This is a popular belief held by many people, but it's wrong. The correct one is high risk equals high ignorance. The right approach to investing is high intelligence leads to low risk, which can lead to a high and definite return. Now, in the long run, walang chamba-chamba or beginner's luck in the stock market. It's all about knowing the correct knowledge. Now, I'd like to share this mini anecdote from one of my online mentors. And here's what he said. Luck is simply labor under correct knowledge. So, if you want to be lucky, you have to take action. That's what labor means. And your action must be done with the correct knowledge. Now, since I know you're already doing the labor part, I'm going to give you tips for finding correct knowledge. This is how you should learn about any topic or endeavor. Learn only from experts. This means you have to first learn from people who are giving out seminars and have written books about their topic. The reason is that seminars and books provide you with comprehensive, big picture, and complete information about the topic you're learning. Only when you have read books and attended seminars should you read up in blogs, magazines, and watch TV shows about investing like ANC's On the Money. The reason why this shouldn't be your primary source is because the information they can give you is limited. Blog articles are usually 1,200 words long. Magazines also have word limits. TV shows are only good for 30 minutes per episode. Now, you have to remember that these sources of information are also part entertainment. Blogs need to have catchy titles, nice pictures, and shareable content so that people will share and like it, while magazines and TV shows have to keep it entertaining so that they'll get more advertisers. And this need for entertainment can sometimes get in the way of education. So if you want pure education, learn from the books and seminars first. Now, the last place where you should be looking for information is in forums, friends, and family. In forums, you don't know who is responding to you and there's no personal accountability. Tago sa code names ang mga tao. You don't know the people responding to you. Then, for friends and family, only ask them for advice if they themselves are good with the topic. Yes, friends and family care for you and your well-being, but be very careful about the advice they give you because chances are they aren't the experts. On average, their sources of knowledge would just be based on personal experience, popular beliefs, and chismis yung nangyari kay ganito, kay ganyan, yung kapitbahay ni ganyan, and so on. It won't be based on disciplined and objective study of the topic. Now, by following this order of learning, you're ensuring that you get the best and the most comprehensive sources of information out there. Reading books and attending seminars may not be as convenient as just watching TV or reading articles, but the information that you're going to get is going to be so much better. When it comes to risk and learning about investments, you should never ask, is blank risky? Questions like, is the stock market risky? Is real estate risky? Is forex risky? Is networking risky? These are all bad questions because these questions make you feel helpless. It takes away the responsibility of being intelligent when it comes to investing. So, it's better to ask, what are the risks and how do I eliminate them? With this, you're putting yourself in a position of power over the investment. When you ask this question, you fully understand that investing is not about luck, it's not about risk, it's not about chamba, it's about intelligence. Remember, high intelligence equals low risk and high and definite returns. Now with that, let's apply these questions to the stock market. What are the stock market risks and how do we eliminate them? The primary risk in the stock market is that we do not know where it is headed in the short term. With that, the biggest problem that you'll encounter is when your personal situation forces you to sell your investment at a time when the market is bad. Here's what I mean. Let's say you invested in 1997. Then, in 2003, the stock market went way down. Your investment got halved. During that time, you'll see a negative 50% in your portfolio. But that's what you call a paper loss, meaning it's just a loss on paper. It won't get realized until you actually sell the investment. With a paper loss, you can just wait it out. So, if you can wait for it to go back up again, that could be in 2007 or in 2012 or perhaps today, early 2013. Now, if personal circumstances forced you to sell when the market was down like in 2003, then your paper loss would become actual loss. Personal circumstances like losing your job, getting into an accident, you may be suddenly forced to withdraw your investment. So this is how you lose money in the stock market. So to prevent the problem altogether, only invest money that you don't need in the near future. Here's what I mean specifically. Number one, don't use borrowed money. With borrowed money, you're not sure when the person will be getting the money back from you. Also, the interest you're paying will drown out the income from your investment. So if you don't have money to invest right now, save up first. Pay your credit card debt first. Set aside a small portion of your income every month. Don't rush investing because you'll be putting yourself at risk if you're not yet financially ready. Now, number two, don't use money you'll need within 5 to 10 years. Don't use money you'll use to pay for rent within 6 months because if the market goes down, you might lose where you live. Don't use money for next year's tuition fee because your kid might end up as an out-of-school youth. These investing time spans are too short. If you only have months and a couple of years, look into savings accounts and bonds, not in the stock market. But you should be investing money that you'll use for your kids' college education 15 years from now, or your retirement 30 years from now. These are the ideal investing horizons with the stock market. So even if the stock market goes down, you'll be able to wait it out for it to come back up again. Number three, have an emergency fund. An emergency fund is a source of cash that you'll use only in the event of an emergency. For example, losing your job, having an important item, the house breakdown, etc. Your emergency fund will protect your investment from these sudden needs for cash. Ideally, this is 3 to 6 months worth of your monthly living expenses. Here's a quick guideline. For the singles out there supporting only themselves, 3 months worth of your living expenses will be enough. With a double income family, 3 months worth will also be enough. For families dependent on only one source of income, you should have 6 months worth for your emergency expenses. Next, number four, in the event of big accidents, your insurances will be the ones that protect your investments. So that even if your house gets on fire or your car gets flooded or there's a sudden need for medical care, the insurance company will be the one to shoulder the expenses, and your stock market investments will be kept safe during the unfortunate times. Now, I know that I gave you a lot of things to do right here, and it's your choice to follow them or not. The main point here is that you should prevent the sudden need of having to withdraw your investments because that event is the primary source of risk in the stock market. So by following these 4 simple guidelines, you are eliminating a huge portion of the risk in the stock market. This is what will enable you to get high returns for low risk. Now, let's proceed to the last portion in this video, the ways of investing. There are 3 ways you can start investing in the stock market. I'll go through each one of them while discussing the advantages and disadvantages. Then at the end of it, I'll be suggesting a recommendation for the average Filipino investor. The first method is through a mutual fund. A mutual fund is simply a collective form of investment wherein different individuals put together their money to be managed by a professional fund manager. Then, this fund manager will be the one taking full responsibility for the investment decisions. So, parang inassign mo yung fund manager to make your investment decisions for you. Now, take note, there are different kinds of mutual funds depending on where the money is invested. If it's invested into bonds, it would be called a bond fund. If the funds are invested into the stock market, then it would be called an equity fund. If it's invested in both, then it's called a balanced fund. Now, if you would want to invest in the stock market, then what you would have to look for is an equity fund. The primary advantage of investing in a mutual fund is that it's stress-free. There's no hassle at all because the money is being managed by a professional fund manager. So all you have to do is fill out the paperwork and write a check to the company, and that's it. you no longer need to worry about when to buy or sell because it would be the fund manager that would do that for you. Now, the disadvantages are it's higher cost because essentially you're paying someone else to invest the money for you. So that person needs to get paid, and as well as the admin staff that makes the whole process work. So with mutual funds, you may get fees total up to 5%. Well, you can consider this to be the cost you're paying for your convenience. Now, the bigger disadvantage that I'm seeing here, and many people may agree or disagree with this, is that there's minimal learning because you don't study the companies, you don't make the decisions. So all you're learning is how to write a check to someone. And for me, that's kind of a bad skill to develop. Now, next is the live broker. This is what you see in movies wherein the character calls up someone and asks them to buy me shares of XYZ and sell stock ABC and so on. So, a live broker is a living and breathing person who is licensed to give you professional advice on your investments. The good thing about this is that you can get specific advice for your investing needs, your investment goals, your timeline, your tolerance to risk, and a good stockbroker will be able to advise you on what you should buy and when you should sell, and notify you of the upcoming opportunities in the stock market. So the primary advantage here is that you get personalized advice and services. You have a living and breathing person to talk to for advice, stock tips, and market information. The disadvantage, though, is that it costs more to buy and sell since the broker needs to make money from the commissions. With that, brokers have a possible minimum investment fee which could reach up to millions of pesos. So it's not that accessible to the average Filipino investor. Then finally, method number 3 is through an online broker. Investing through an online stockbroker is like being your own stockbroker. On your own, you will be able to buy and sell stocks as long as you have a computer with access to the internet. For the market tips and advice, your online broker will be providing you with tons of reports and market information, and it would be up to you how to understand it and how to get the relevant details. The primary advantage that I'm seeing with an online broker is that you get to maximize your learning as an investor. You learn what's happening to PLDT, Jollibee, Meralco, San Miguel, and the other stocks out there. And since you're the one doing the buying and selling, you get to learn more. Now, as an additional perk to that, you have to pay the lowest commission rate allowable in the stock market, which is only 0.25%. So you get more bang for each peso you have. Now, the do-it-yourself thing may not appeal to some people, so I've also listed it as a disadvantage. So among those 3 options, between a mutual fund, a live broker, and an online broker, what I'm recommending is that you go for an online broker. There's less cost and you maximize your learning. And among the online brokers out there, I'd have to say that the best one is CitySec Online or COL Financial, as you can see in the picture to the right. Now that's their homepage. CitySec Online is the largest online brokerage in the Philippines, and they provide good research and market information, and also they're very aggressive when it comes to spreading financial literacy. They even hold free seminars on how to invest in the stock market weekly in their office in Ortigas, and they also do the seminars in provinces by request. Now, regarding these seminars, there's no need to attend their basic ones since the topics are already covered in this seminar series. I'm just saying that I like their advocacy for spreading financial literacy. And just as a note, I'm not an employee of COL Financial, nor am I an affiliate, nor am I being paid to recommend them to you. I am just a very satisfied customer. Now, that's the end of video number 2, the basics of the stock market. Now, you should know how the stock market works, how to minimize the risks in it, and how you can get started. So here's your action step to get you started. Below this video, you'll see a download link to the application forms for CitySec Online. what I want you to do right now is to download these forms and print it. Okay? So download the forms and print it, but don't fill it out yet. At this point in time, I just want you to have the forms ready with you so that you can get started as soon as possible at the end of this video tutorial series. If you don't have a printer at home, please decide right now how you can print the forms, whether it's at work or at a friend's house or at an internet shop. Send the forms to your email so that you can easily access it when you have a printer accessible to you. So thank you for watching this video, and I hope you learned a lot. In the next video, we'll talk about the different investing strategies in the stock market. So this is where you learn the buying and selling process. How do you do it? You'll receive the link to the next video 2 to 3 days from now in your email, so watch out for it. In the meantime, please leave your comments, questions, and reactions below this video. I'll be reading and responding to them personally. Until then, work hard, work smart, and make your money work hard for you.